How can we tell if a stock is undervalue or overvalue? Hey guys, this is John from Pokkai Bro. Welcome back to my channel. In this video, you will be learning 3 valuation indicators that I normally use when evaluating a company. They are the price to earning ratio, or what we call the PE, and also the forward PE ratio, the enterprise value, the growth on gross profit and profit before tax, 2, growth of revenue, and some of the honorable mentions. Before we start, you know the house rules, right? Make the like button turn blue by gently tapping on it, subscribe to this channel, and click on the notification bell so that you will get notified whenever a new video is released. So imagine that the cost of cutting your hair is about 10 ringgit. And during the lockdown, you decided to cut your own hair and invest in a hair shaver that costs you around 60 ringgit. So in order to earn back your investment, you will need to use the hair shaver 6 times. So how did I get that number? You take the money that you have invested in the hair shaver and you divide by the cost of cutting your hair. It means if you use the hair shaver 6 times, you have actually covered your cost of investment. And if you use it more than 6 times, you are indirectly earning a positive return on investment. In other words, the PE ratio can tell you how long will it take for you to recoup back your investment. In Investopedia's definition, the price to earnings ratio is the ratio for valuing a company that measures its current share price over its earnings per share. Or it can also be calculated as the current market capitalization of the company over its annual profit for the year. The PE ratio is widely used by investors and analysts to determine the company's valuation in an apple-to-apple comparison. The keyword here is apple-to-apple comparison, yeah? For instance, comparing 𝐒𝐔𝐁𝐒 and Tongguan's PE ratio, who are both in the plastic packaging industry. Besides PE, another method to calculate a company's valuation, and it's also one of my personal favorites, is the forward PE ratio. So a forward PE is derived when we want to determine the company's future valuation by forecasting its future earnings. So similar to the PE ratios formula, we are comparing its current share price to the earnings per share, but instead of looking at its current EPS, we are looking in the next 1 to 2 years projection. So why forward PE is paramount as opposed to the normal PE is because the stock market is always forward looking. So this means the share price movement that we are looking today may be reflecting in the company's earnings for the next 6 months or even 1 year time frame. And one misconception that many investors have is when they see a high PE ratio like 80 to 100 times, they will feel that the stock is overvalued. And vice versa, when they see a very low PE like let's say 5 or 6, they will feel that the stock is undervalued. And that is why it is very important for you to understand the business fundamental to see whether if the company can perform better in the next 1 to 2 years so that you can avoid this value trap. One of the classic example is the glove sectors back in April to August 2020, where companies like Top Glove was trading at 50 to 80 PE. And at that point of time, everyone thought that the gloves were overvalued. But when their Q1 and Q2 earnings report for financial year end 2021 was out, its PE ratio actually dropped from its peak at 114 times all the way to 6 times, which essentially tells us that the company's high PE at that point of time was justifiable. However, that does not mean that all companies with high PE are good. If the future business prospects and fundamentals can justify its high PE, then most likely the stock is still trading at a fairly valuation. And it also applies the same to the low PE stocks. Next is the enterprise value, and by definition, it is a measure of a company's actual total value and is used in a more comprehensive alternative to the market capitalization. It involves the calculation of market cap with its cash on hand, short-term and long-term debt. To put it in perspective, let's say you bought 3 magic box and it costs you 10 ringgit each. And inside the first magic box, you discovered a 6 ringgit note. Wow. So that means the first magic box actually saved you 6 ringgit and you only paid 4 ringgit for it. But don't get too excited because you have just discovered a debt of 5 ringgit in the second magic box, which means you have actually paid 15 ringgit or 10 ringgit plus an additional 5 ringgit for the debt for the second magic box. In the third magic box, you have found two things in it. A 8 ringgit note and also a debt of 5 ringgit. Now, take a guess, how much did you actually pay for the third magic box? So you got your answer? Okay, so the answer is 7 ringgit. So based on the example that I just gave, it basically explained the formula of enterprise value, which is you take the market cap of the company and you minus its cash on hand plus the short and long-term debt. So why is enterprise value so important is because it tells us the actual value of the company after inheriting their cash and debts. But a downside of this indicator is that we cannot apply this to all industries. Take it for example, like a company that holds more debt than they do cash does not mean that they are bad. For instance, like the REITs or what we call the real estate investment trust. It is because their business model is highly leveraged on loans or debts to make money. So this indicator may only be effective to certain companies depending on the industry's nature of business and also the company's business model. Another way to value a company, and I think that not many investors or analysts have shared about this, it is comparing the growth of the gross profit and profit before tax to the growth of the revenue. What do I mean by growth is the company's compound annual growth rate, or what we call it as the Kegel. Generally, how far I will look at the company's growth is roughly about 5 to 10 years. How do we calculate the Kegel of a company? Firstly, you need to download an app called Easy Calculator on iOS, or I think it is called Financial Calculator on the Android. And the application looks like this. After you have installed it, you want to go to the TVM calculator. And this TVM calculator can actually help you to calculate the Kegel of a company. And I'll show you how. Let's use Vitrox as an example and calculate its 5-year Kegel for its revenue from 2014 to 2019. From its annual report, we'll need to find out what's the company's 2014's revenue, and we'll key in at the present value, and also we'll key in its 2019's revenue at the future value. Do take note that at the future value box, you'll need to put a negative sign before the number. And after that, since we are calculating its 5 years growth, at the period box, you will want to put, you just want to key in the number 5 over there lah. So once you have done that, the final step is to adjust the setting, which is you just basically change the compounding period to annually. And the final step is just tap on the rate and you will see Vitrox 5 years Kegel for its revenue is about 14.85%. But wait, we are not done yet. You still need to find out what is their growth for the gross profit and also the profit before tax. So after you got all the data, you then want to compare the numbers to the growth of revenue. So let's say if the Kegel of gross profit is higher than the Kegel of revenue, it means that the company has economies of scale, which basically tells us that the company can increase their production while maintaining at a low production cost. On the other hand, when the Kegel of profit before tax is higher than the Kegel of revenue, it basically suggests that the company has a great operation efficiency. A bonus tip here, if let's say the growth of the share price is slower than the growth of the mentioned metrics, the stock may be trading at an undervalued price and nobody is paying attention to it. So those are the 3 main valuation indicators, and here are some of the other underrated indicators that I would normally look through as well. So the first one will be the receivable turnover, which tells us how fast the company takes to receive payments for their product and services. It shows how efficient the company is at receiving whatever short-term payment it is owed. Generally, you want the receivable turnover to be shorter. The second one will be the inventory turnover. The inventory turnover tells us how fast the company is able to sell their products. A short inventory turnover suggests that the company is managing their unsold products well. We have come to the end of this video. Hope you guys enjoyed the content, and if you did, make sure to like this video because it helps out the channel a ton. If you have any questions, feel free to comment down below. I read each and every comment and I appreciate it if you do so. Thanks for watching, and I'll see you on the next one.